The stock market rally looks like it will continue into the new year with positive news continuing to come in. Some of that news includes the Phase 1 trade deal between the U.S. and China. With that deal, the U.S. will cancel tariffs on Chinese goods that were to go into effect on December 15th. In turn, China is expected to purchase a significant amount of U.S. agricultural products. Though the price amount was not disclosed, don't hold your breath. The Chinese have no intention to live up to their promise. Additionally, the Federal Reserve has indicated it won't be hiking rates anytime soon. More importantly, the central bank is now planning to offer a total of $525 billion in liquidity via repo operations. And lastly, we've had a stream of better U.S. economic data this last month. So, what does all this mean going into 2020? Let's take a look. In total, there are simply more reasons to be bullish on stocks than to be bearish. More importantly, the underlying fundamentals of the market appear to be relatively strong. Just looking at the U.S. right now, interest rates are favorable, and so is the Fed's balance sheet, or at least the Fed's plans for the repo operations. Both will encourage liquidity to come into the market, and that is going to drive the markets higher. It may not fix any underlying problems, but it will drive the markets higher. And as this chart shows, the news is spreading. This is the MSCI AWI index. It measures the performance of emerging and developed markets. As you can see, the index has broken out to a new 2-year high. According to Sundial Capital Research, historically, after the MSCI index breaks out to a 2-year high after more than 400 days, the S&P 500 has rallied by a median of about 5.1% over the next 6 months, and the 1-month median gain following the breakout is about 10.4%. One of the recent problems that you may find investors talking about is although the markets are hitting all-time record highs, the list of companies hitting their 52-week low was increasing, and this can be a problem for any rally. However, as shown by this chart here, a wave of new highs on the New York Stock Exchange has surged in recent weeks back to levels not seen since December of 2016. When new highs versus new lows on the exchange exceed 400, which there are currently about 500 as shown on the far right of this chart, and for the first time in about a year, the S&P 500 has gone on to rally a median of about 15.4% during the subsequent year. And this third chart here is the New York Stock Exchange Composite Index. The index includes over 1,900 stocks and hit a record high on December 12th. And according to Sundial Capital Research, when this index has broken out to new highs in the past, the median gain 1 year from the breakout typically reaches about 9.9%. So now let's go take a look at one last chart. And this last chart here is the iShares Russell 2000 ETF, and the symbol is IWM, and it's the 20-year monthly chart on the Russell 2000, or a proxy. Now, you've heard me talk about this before. With regard to the different indices hitting records, the Russell 2000 has been the laggard. And it was my proposition that the market is not going to be in rally mode, or we're not going to have a confirmed rally until the Russell 2000 joined in. Well, guess what? It's almost there. You can see here by the price chart that we hit a high of 163.33 on Friday. Now, that's not quite a new record high, but that's incidental compared to this, which is the MAC. As you can see here, the MAC has bottomed, based, moved up, and it's just about to move the fast line through the slow line. The fast line being the black line, the slow line being the red line. So the black line is about to move up and through the slow line. And to me, once it does, that means that all indices are moving on up And in my opinion, we have a confirmed rally underway. And as you can see, it's very similar to this pattern back there in 2015 to 2016. And in my opinion, again, I believe things are going to be on their way soon enough with that fast line closing through that slow line here very shortly. And for today, that's ChewDog Charts. Thank you.